Are we in the midst of a new bull market and earnings cycle, especially for many of the lagging areas of the index? That was your call in mid-November. Is that a call you still stick to?
Yeah, well, good afternoon. First of all, I would say yes. I mean, the story we actually started writing about in May of last year, which was our mid-year update, was exactly that. I think our view still remains out of consensus around this idea that Liberation Day marked the end of what we call a rolling recession. So we're actually not only in a new earnings cycle, we're in a new economic cycle. And that's why we're seeing the broadening out now, because there have been many parts of the economy that have been sort of mired in a recession for the last 3 years or so. And they're just now starting to emerge. Areas like consumer goods, some of the financial sector, industrials, obviously, which is getting a boost from AI capex, but also getting a boost from, basically underspending for the last several years. Parts of technology are still doing quite well. And so that broadening out is the real story. And we doubled down on that in November because the evidence was coming through. And, in May, we didn't know, but now we know. I mean, the earnings growth for the median stock in the Russell 3000 is now running double-digit growth year over year. That's the first time we've seen that in 4 years. So it's happening. The question now is, how long can it last? What could derail that? And, what do you pay for? I mean, those are always the questions. But the first part of your question is a resounding yes. We are in a new earnings and economic cycle, and the market has figured that out.
Hey, Mike, it's been pretty remarkable to see that we've gotten this tremendous stock volatility at the single stock level, also at the sector level. But when you look at the S&P 500, it actually hasn't really done much this year. What is it going to take to break us out of this range? And what could be the catalyst to get us past that elusive 7,000 level that everyone's waiting for?
Yeah, that seems to be the question. I mean, obviously, stock investors don't. I mean, if you can make money in other areas, that's fine. I think that's the real main message, is that the market is not going anywhere at the S&P level, but there are many sectors that are doing well, and that's the name of the game. Now, to your question, I think what's going to break us out ultimately are two things. Number one, there is some uncertainty around the AI capex cycle and the disruption that perhaps it could cause in the labor market and other areas. So I think we're in one of those testing periods now. We wrote about that this week. We think that ultimately it's a little bit premature to kind of throw a cold blanket on the AI cycle. It's just getting going, from our standpoint. And then secondarily, I think we have a new Fed chair nominee with Kevin Warsh. And the market always tests the new Fed chair, whoever it is, when they come into power or office. And so first we have to go through the confirmation hearings, and then we got to learn a little bit more about what he really intends to do. So that could lead to this, the market kind of struggling for another month or two. And then ultimately, we think once he takes office, we think that'll be another catalyst for why the market can have a really good second half. And we stand by our $7,800 price target for the S&P by the end of this year.
Okay, so those are all the reasons and more that you think we could see a 16% increase in the S&P 500 this year. What changes your mind, Mike? What could happen between now and the end of the year that could cause you to go back and sharpen the pencils, break out the Excel, and say, wait a second, we got to recalculate this?
Yeah, well, we do that every week anyways, because it's the name of and we have to. But I would say, what would change our view is probably the things that are going right now. So, for example, if we would see the earnings cycle start to deteriorate, and that could happen, it's not our forecast, but if the earnings revisions were to start to narrow again or start to really break down, that would be clearly something that would change our view. The second would be that, the fear around Kevin Warsh being kind of a balance sheet hawk, where, he's going to maybe shrink the balance sheet. And we're going to have a little bit of a liquidity problem, potentially. That would cause multiples to come down. We don't think that's going to be the case this year. That might be a story for 2027. We'll think about it then, but maybe we're wrong on that. The other one, of course, is yet another exogenous shock of some kind. And I think, the one I mentioned earlier is starting to weigh on stocks here in the short term, which is this concern that, AI is happening so fast and it's migrating now into the corporate world, that we're going to see a big labor cycle. That's not our view, but it could happen. And so those would be the top three, I would say, that could derail our positive view for this year.
We've heard time and time again that big tech's profits are going to slow, that it's time to rotate, and anyone who's said that for the last few years has been wrong on that. Do you think that this year is different? And when you think about the end of 2026, when we close out, who are going to be the new winners?
And I love that you went there because, Mike, it feels like the last 3 years people have said, get away from big tech, diversify, and yet that's where we've seen so much of the gains. It's a great perspective.
Well, I mean, I think a lot of people also made the other side of the call, which is to kind of upgrade small caps or the equal weighted S&P. We didn't do that. We don't get everything right, but we waited until November to make that call because our view is not that tech earnings are going to collapse. It's that the rest of the market's earnings are going to improve. And that's what usually drives relative performance. So it's really the spread between sort of the Mag 7 or large cap growth stock earnings growth and the other 493 stocks or the other equal weighted index, whatever you want to call it. And that spread is narrowing now. And so the areas that we have been recommending is based on where that earnings growth is accelerating the most. That would be things like consumer goods or financials, some of the industrial segments, some of the small mid-cap areas. And we stand by that. That's what we're seeing, and that's what we think is going to continue for the rest of this year. And that's really the story. It's not an anti-tech or anti-large cap growth call. It's more of just a bullish call on all these parts of the economy and the market that have been under earning because of this rolling recession.
So is it fair, Mike, to say that you like the equal weighted version of the S&P 500 more than the main index?
Absolutely. That was one of our lead calls in the November outlook. And that has worked so far. So knock on wood, hopefully that continues. And based on what we've seen so far this year in the earnings and what we see kind of in this, the economy itself, which I think, quite frankly, is booming at the moment because you have capital spending increasing and consumer spending holding up. That's a much better environment for the average company.
Hey, Mike, two things I'm curious about. Do you think the White House is still a risk to financial markets, or with midterms looming, do you think that the president and his team are going to be very careful about unsettling things in the financial markets? Many have said he certainly keeps an eye on it. Maybe that's the checks and balances on the White House. And secondly, Kevin Warsh, if indeed he does become Fed chair, will he be an independent Fed?
Yeah, no, I think that this administration and the president, specifically, has shown that he's going to kind of operate at his speed, and so I don't anticipate that we're going to see, for example, this administration trying to lose momentum in what they're trying to achieve, which means more of the same. Quite frankly, it's going to be active, and that creates periods of volatility, uncertainty, whatever you want to call it. But I mean, I think the mission and what they're trying to accomplish is now crystal clear. They're trying to rebalance the economy on 3 different planes at the same time. And I think they're having some success with that. That's why we're seeing productivity increase already. We're seeing GDP increase. We're seeing, earnings, broaden out. And so as long as they're seeing results like that, I think they're going to stay the course. With respect to the Fed independence, I mean, I've probably had a bit different view here. I mean, as far as I can tell, the Fed independence has been sort of fading for the better part of 20 years, really since the financial crisis. And when I say independent, I don't mean they're under the thumb of the White House. What I mean is that they have to play ball in terms of their role to help the government fund itself. Okay, and we saw that after the financial crisis. We saw that in 2012. We saw that, when we had a regional banking stress in 2023. So the Fed is obligated to help financial markets operate. I mean, it's their third mandate. I mean, they even call it that. So that to me is where the Fed independence has been challenged for the better part of 2 decades, and I think that's going to continue. I think the Fed and Treasury are going to work closer together, similar to the post 2000 World War II period, and that's a good thing because that means they're going to figure it out.